In this presentation, we will generate and analyze financial statements and payroll forms after having processed payroll, which includes a salaried employee and a bonus for that salaried employee, comparing and contrasting it to prior payroll, which does not include the bonus. Also noting that the bonus will put an individual or the salaried employee over above the cap for Social Security, and looking at the effect on that for the calculation of Social Security taxes within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our S-Corp paid payroll file. We're going to go down to the reports on the left side and select our favorite report, that being the balance sheet, the financial statement report. We'll change the dates up top from 01/01/19, 12/31/19. That's going to be January through December 2019, and run that report. We know that the basic payroll will be a decrease to cash and recording of payroll expense, and then we'll think about that journal entry first, and then think about the withholdings and other complications related to it. We then have the checking account, so if we select the checking account, we have the payroll for Judy Jones is the one we're focusing in on for February. So we're looking at Judy Jones. We can see it's much higher here. The difference is due to the bonus. So the bonus was a large bonus, a $200,000 bonus. Notice this is the net check. So the other side of this would typically be on the income statement. So we'll go back up and go back to our report. We're going to look at the income statement. We're going to create a new tab up top by right-clicking on this tab, duplicating that tab, pulling the one from the left to the right. So now we have the balance sheet on the left, the balance sheet, and we're going to do the income statement or profit and loss on the right. We're going to go down to the reports on the left tab, select the profit and loss report, and then we'll change the dates up top from 01/01/19 to 12/31/19. That's January through December 2019, and run that report. Then we'll scroll down. We're going to look at the wages. That's going to be the expense side of things. We'll select that wages item. Then we're considering here the Judy Jones. We can see the large check for Judy Jones with the large payroll amount. That's going to include the payroll from last time, which was the 41,666.67 plus the 200,000 payroll. This then is the gross pay, what was earned in wages as opposed to what was paid out in wages. So if we go back up top, we're going to go back to our reports. If we consider the difference between those two, the check and the wages, we're going to go back to the balance sheet. That will primarily be in taxes payable, including the federal income tax, the FIT for the employee, the Social Security, and the Medicare. We also have withholdings related to the 401k plan, California withholdings, dental insurance for the employees that qualify for it, the eye or vision insurance, which was taken out of the check as well, any garnishments taken out of the check, the health savings account, the medical provider. This is provided by the company actually and not taken out of the check. And then the S-Corp insurance specific to our owner. So these are liabilities related to the payroll items. If we go back to the S-Corp tab, which is the income statement, the other side of the transaction is in the taxes. So these are going to be the payroll taxes. So if we select the payroll taxes, we'll see payroll taxes related to Judy Jones for the month of February. And of course, once again, they're going to be higher. These are the employer taxes we typically think of as a kind of another journal entry or another transaction that happens at the same point in time when we process the payroll. And then if we scroll back up, back to the income statement, the other side of that to balance out is on the balance sheet. And that's typically in the federal taxes as well, the 941, the Social Security, and Medicare for the employer side of things. If we go back to the income statement tab, we'll also see these other two items for health insurance and retirement. So these are going to be the items that were over and above, paid over and above the gross pay, and therefore have their own expense accounts. If we go back to the balance sheet, we'll see the other side of those that's going to be included in the 401k and the health insurance payable, medical insurance provider. Now we'll take a look at another payroll report. We're going to go to the second tab and then duplicate it by right-clicking on it and duplicate. Then I'm going to pull the tab from the left to the right. So now that we have the balance sheet, profit and loss, and then the new tab, we're going to go to the reports on the left side. We're going to scroll down the reports to find the payroll reports, and we want to look for the payroll detail. So we're going to select the payroll detail report, and we're going to choose the first quarter. So we'll look at the first quarter, selecting the drop down and picking that first quarter, January through March. We want to consider Judy Jones within that first quarter. We're going to run that report. And Judy Jones for February. So the last payroll, March, is up top. So we want to go to February's payroll, and here it is. Here's Judy Jones in February. And the big difference, of course, is this $200,000 that is now in the bonus section, calculated as part of the salary. That is what is not included in Judy Jones' salary if we go down to the January payroll, where we just have the 41 salary and the S-Corp. So, of course, that will then affect the payroll calculation. So we have a big difference in terms of the federal income tax, the Social Security, and Medicare based on that change. We also note that we have this cap that was hit in the Social Security. Therefore, the Social Security is not just a flat rate now. We had to figure out, or QuickBooks figured out for us, how much of that income was needed to get to the cap, and then not calculate any more payroll tax for Social Security at that point in time. So that cap is a huge thing to know when you're considering payroll for large income individuals. People that are going to earn more than $100,000 are eventually going to hit that cap. If they earn significantly more than $100,000, $100,000 to $120,000, the cap will increase over time. So you just want to be aware of it when the income gets around that area, to know that you're going to hit the cap at some point in time. Now we'll make another tab. We're going to go back up top, and we're going to right click on this tab again and duplicate it. We're going to pull the tab from the left to the right, so that now we have a new tab, and within this new tab, we're going to go to the taxes down below. We're going to look at the payroll taxes up top, and we want to consider the quarterly forms. So we're going to look at the quarterly forms. We have the employee quarterly forms. We will select the 941. So we'll select the 941 for the first quarter, January through March. Scroll down and preview. So we will preview those items. And here's going to be the 941 for the first quarter, January, February, and March. We have the 2 employees because we haven't processed payroll for the last month for all of our employees. And that's why QuickBooks isn't processing all of the employees here. So just be aware of that. We have the wages up top, which of course now includes that $200,000. Note now that we have a lot of difference between the wage calculations in this form. So we have the FIT wages now being different than the Social Security wages. Social Security now being less than the wages for the FIT, which is the opposite of what we had up until this payroll because of that cap being hit. Then we've got the taxable Medicare wages. So there's the Medicare wages, which is actually the highest wages. So that's going to be higher over here, and therefore probably the best indicator of what is actually what compensation was. So this is going to be the closest to actual compensation generally. Still, it's probably low because we'll see that there's some items that are compensation that aren't included in here. And then we have the added amount for the Medicare tax. So this is going to be above a certain threshold. This, of course, being because of the bonus as well. We have this added tax for the additional Medicare tax withholdings. So let's first take a look at our quarterly forms. Here's our quarterly form. If you want to run this again, sometimes when you create a new tab, it messes up the running it. So run it for the first quarter, January through March. And if we scroll back down, then we're going to say here is the total gross pay. It includes the regular pay, the OT, the salaries, the bonus, and that S-Corp of the $4,000. So that's all considered compensation in some format. So we're going to say that adds up to 311,708.34. That's what we have there. And we're going to say minus, and then go back to our reports and look at this number, the Medicare wages, which is closest to actual, and we'll say actual compensation, minus 307,408.34. And that's going to be 4,300. So what is that difference? How did they get this number? Well, if we go back, we're going to say, all right, the 4,300 is going to be that S-Corp, which isn't being included, so it's not being taxable for Medicare. And the other 300 was that HSA. And that's because of the settings we used to enter the health savings account. Next, we can consider this 307,408 compared to the FIT wages to see if we can reconcile those items. To do that, we're going to say, okay, here's the 307,408.34 minus the 304,002.08. So this number minus this number, the Medicare minus the FIT wages, we have a difference of 3,406.26. What is that? Well, if we go back over, we know that for the FIT, we generally do not include the withholdings. So withholdings are going to decrease the wages for FIT. So that's part of it. Let's subtract that out. We're going to say, okay, minus 7,406.26. That gives us the 4,000, which is that funny S-Corp item. So it's only there for the S-Corp. So the difference between those two items, in other words, is going to be the 401k 7406.26, which is not included in FIT wages, but included in Medicare wages, minus the 4,000 S-Corp. And that gives us that difference of 3,406. So then if we go back up top, we've basically reconciled this item and that item. The Social Security, we won't go through the exact calculation of it, but just note what happened, of course, is that the cap was hit by that one employee. So the one employee, Judy Jones, hit the cap. So Social Security will be calculated in a similar way for all employees except Judy Jones as Medicare. So it'll be similar to this calculation for the Medicare. And then for Judy Jones, however, it'll be capped at what the cap is. So it'll stop at that cap, and we won't add any more Social Security. That's why there's this huge limit here, because she went substantially over the cap, and that amount is now no longer included in Social Security. So that would only happen if you had someone earning a significant amount of money, over $100,000, that would then hit that cap, and therefore you have this issue of this number for Social Security being different than the taxable Medicare. And then we also have the Medicare bonus, again, for higher income individuals. Once it gets over the threshold, we have an added Medicare. So Medicare actually goes kind of the other way from Social Security. Social Security gets capped, and then there's no more Social Security tax. Medicare, once you're over the threshold, has an added bonus tax based on that portion that's going to be over that threshold. And that's what this 83,333 comes into play for. So you'll notice that payroll's fairly straightforward as long as the payroll's fairly low, because these numbers oftentimes will be the same even, or slightly different, or we'll know exactly what that difference is. But as we add benefits, and as we deal with people who have higher incomes, then this becomes more complicated, and we'll see differences between these wage numbers. This 304,002 is the FIT wages. Here's the FIT tax based on it in accordance with the tables calculated by QuickBooks. And then we have the Social Security times the Social Security rate, which is 2 times like the employee rate, or includes the employee and employer rate. This then being the employee and employer Social Security. Medicare times the employee and employer rate, this being the employee and employer Medicare, and then the bonus amount. So if we add all that up, this is going to be the tax for FIT, Social Security, and Medicare. You'll note as we scroll down that we no longer are available to use or can use this month-by-month breakout, but then have to go down and add the schedule now, a Schedule B. So we have the Schedule B outline or detailing this information. Schedule B is often used if we pay more than on a monthly basis. So if we have higher payroll or pay more often, we typically need a Schedule B. And this is going to be a form that's going to calculate the liabilities on a month-by-month basis. In other words, if we had multiple payrolls that were run in the first month, in the month of January in our case for the first quarter, we can put those multiple different payrolls and the liabilities related to them, add them up for that first month. Second month, we can do the same thing, breaking out this information by the payroll. Now, of course, for our cases, we only did this on a monthly basis. That's why we only have the one number here. But because the one payroll was high, that's going to kick us over to needing to fill out this added form, the Schedule B. For more accounting information and accounting courses, visit our website at accountinginstruction.info.